We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Matt Geiger, managing partner of MJG Capital. How are you today, Matt?
Doing great, Tom. Thanks for having me back on the program. Always good to catch up.
Absolutely. It's been, I can't believe you and I were talking before we hit record here today that it's been just over a year since we spoke last, which is just kind of mind blowing considering, you and I have talked quite a bit in the past and met in person from time to time, which is the pandemic really put a damper on all of that travel and seeing each other and a lot of the conferences, but it's good to see that you're back out and really getting boots on the ground again and seeing the industry, as I know that you are very good at.
Right. Sounds like you've been keeping busy as well. But yeah, February and March in particular was a pretty crazy period there. I think, site visit to Egypt and 5 conferences and then that 8-week period, maybe it was 4. But largely living out of a suitcase. But I enjoy being on the road, and it's definitely things are fully opened up now, which is great.
Mm-hmm. Yeah, I love being on the road too, and we continue to see such a risky and turbulent environment in the overall markets here, and sure. I just kind of want to get your sense of how this has really presented. In some ways, a risk-off environment in the mining sector. What conditions would show us what market psychology is at work, even within the mining sector? Can we point to, the underperformance of miners versus their underlying metals as a symptom of this?
Well, good question. I would say for the broader market, there was a real trifecta of factors in 2021, which all came to a head. Rampantly high valuations, absolutely euphoric sentiment, and incredibly accommodative monetary and fiscal policies for that matter. And that to me seems like a clear flashing red light for the broader markets. And you never quite know when the fun is going to stop, but that whole year seemed a little bit like a fairy tale to be real. Mm-hmm. The steam has definitely come out of the balloon to some degree here. Obviously, 2022 was a rough year for the broader markets. But even still, if we saw the bottom last year of this current downturn, and I wouldn't rule that out entirely. It is within the realm of possibility that we have seen the bottom. But if that were to be the case, this drawdown again in the broader markets would be incredibly short-lived and shallow from historical perspective. And it really the confluence of those events and the craziness we saw late in 2021. Tells me that there's probably more, of the excesses that have yet to be cleared. Obviously, there's been a decent bear market rally here in the broader indices. That's largely lasted for a good, 6 months at this point. And, there's a bit of a sense of calm that has returned to the broader markets. My expectation is that there will be another leg or more lower at some point here. But that said, it could be a little bit longer before that occurs. I should note that going back to the mid 1980s, there's been 6 periods where there's been a pause after a sustained rate hike cycle, and we're just about to enter that period. And in all 6 of those instances, upon the pause, there have been rallies in the broader market, and actually in 5 of those 6 instances. The broader markets went to all-time highs. I'm not expecting that to occur in this case. Probably think this would be more like 2000, where we saw the market rally 11 or 12% upon the Fed pause before resuming its path lower. But there's no inevitability that things are gonna collapse tomorrow. Historically, we could be in for another few good months within the broader markets. And again, going to all-time highs, historically, history tells us is within the realm of possibility. That's where I stand on the broader market. Obviously, that has clear implications for mining investing, and especially junior mining investing. It remains the case from top to bottom throughout the junior mining or throughout the mining industry. When the broader market goes risk off, we feel the pain, really, regardless of what the macro or industry specific fundamentals are. I'm of the belief, or I feel very strongly, that we have a nice decade ahead of us in investing in metals and mining and natural resources more broadly. And that's for a whole host of reasons. You look at relative valuations between commodity prices and the broader stock market. You look at relative valuations between commodity equities and your average non-mining equity. You look at the CapEx deployments that we're seeing, whether it's in sustaining CapEx expenditures to increase production at existing mines, whether it's new mine builds, whether it's spending on advancing development projects, whether it's spending on grassroots exploration. We've had a decade of minimal to no expenditures really across the board. And even though commodity prices have certainly perked up over the past couple of years, we haven't seen that wave of spending hit. And so, really you look across all these different metrics, and it suggests to me that we have a good run ahead of us. That said, in the immediate term, especially if the market goes risk off, mining investors should be braced for painful downside and volatility. And so, I think if the broader markets stay flat or trend higher as we cut this rate cycle, we could see the juniors move. There's no question, as you mentioned, precious metal prices, physical gold, physical silver have rocketed here over the past 7 or 8 months. The blue chip mining equities and the blue chip royalty names have also seen substantial inflows. And it's starting to trickle down even to even into the mid-tier producers. But as a whole, the juniors have been entirely neglected. And I understand that there's a sense of frustration, but I don't think there's anything broken in terms of the junior market. The reality is, if this move is real in precious metals, and I think it is, it will eventually trickle down to the juniors. I guess the question is, does that occur imminently? Or do we have another risk-off episode in the broader market that creates some downside before the juniors move? But I feel quite comfortable about how we're positioned. And I think one could make an argument, the fact that the juniors haven't moved yet may point to the duration or the breadth of the upcoming move here. And I don't mind that they haven't yet. I think that shows that we're still earlier rather than later in this current up move, specifically amongst precious metals. I think the rest of the metals complex is kind of a separate conversation that we can get to later.
Mm-hmm. Well, Matt, you mentioned kind of the real deal for the precious metals here. Do you think that, bumping up against this overhead resistance that gold seemingly has been rejected by, is that creating just a stronger base, a stronger platform, or whatever metaphor you want to use for it, for us once we break that resistance?
I think that's probably the case. I try not to get too sucked into technical analysis. That's not my game. I will say that smart market participants that do follow TA are on the record saying there's no such thing as a triple top. And I would actually say gold's resilience here is extremely encouraging. The fact that gold is sitting at all-time highs after we've seen interest rates go from basically 0% up to 5% in the matter of just over 12 months. The fact that we're sitting here at all-time highs is a sign of absolute strength in the gold price. And to me, whether there's another cut, whether we're already on the pause, that kind of misses the broader point here. We've gone through the pain, and yet we're still at all-time highs here for physical gold. And there's clearly plenty of catch up to be played, both amongst the major miners still, even though they have responded in recent months. And then, of course, amongst the juniors, which, again, there's been, winners here and there on a company specific basis, but we definitely haven't had a rising tide lift all boats move yet. But that will, if this move is real, which I believe it is, that will come. I will say, though, I do think this move is real for a few reasons. The first is that any proper leg higher or any proper move in precious metals occurs from a point of capitulation. So think back to late 2015, or think back to spring 2020 after the COVID washout. Same case here. Going back to September, October, where we saw the bottom, we had just gone through a grinding 2-year drawdown amongst precious metals and precious metal equities, really testing the patience, and all but the strongest hands had been shaken out of this subsector here. Additionally, between March and September, we literally saw the physical gold price drop 7 consecutive months, which hasn't happened in at least half a century, if not longer. Certainly hasn't happened in my lifetime, for 7 consecutive months of a declining physical gold price. And so I feel confident that we were starting from a point of capitulation. That's kind of the first box that's checked. The second, of course, is the macro backdrop. I really couldn't think of a better macro backdrop for gold. All these points have kind of fallen into place. Of course, it's been well talked about, but I don't think it can be underemphasized. The amount of central bank buying that we saw last year was off the charts. Literally going back to the early 1950s, when records first started being kept on central bank inflows and outflows in terms of physical gold, we have not seen a year where central banks have bought more gold. And the impetus for that is very simple. It was Biden's decision to freeze Russia out of the SWIFT system. And at that point, understandably, many countries around the world, especially those that are maybe sometimes at odds with the United States, realized that it probably didn't make sense having the majority of their current foreign currency reserves sitting in US dollars. Doesn't mean you have to go down to zero, but maybe instead of 60% of your foreign currency reserves in USD, you take that down to 30 or 40. And gold filled that gap. And I think we'll continue to fill that gap. So that's one of the macro factors. Obviously, more recently, there's been major concern and questioning amongst the general public of the stability of the Western banking system. You look at Signature Bank, SVB, Credit Suisse, which was probably the biggest of the four, and then more recently, First Republic. Folks are reevaluating whether they want to keep their money in checking accounts and thinking through other other liquid alternatives for their cash. And CDs fall into that category, and we've seen money flow into CDs. Physical gold does as well. If you want a liquid option to preserve your purchasing power, there's no better place to look. So we have that angle going on. And then we have the Fed's historically sharp rate hike campaign coming to an end, as we discussed. And then, of course, the U.S. debt ceiling drama, which is just starting to kick into high gear. This one's going to come down to the wire, and they usually do, but there's really some unique dynamics here in the Republican-controlled House. And also the Democrats in the White House learned from the Obama administration that you don't negotiate over the debt ceiling. At least that's the lesson that they took from past showdowns. And so I think this is a pretty treacherous period here. And it's unclear whether the U.S. government's going to run out of money. In the most extreme scenario, could be mid-June. And a more conservative scenario could be in September. But this summer is going to be volatile, and I don't expect there to be any quick fixes here. So the macro factors obviously are aligning very well. And then I'll just say quickly, as I alluded to in the previous answer, things are playing out largely as they should amongst precious metals. You saw the physical price move first. You saw the blue chip producers and blue chip royalties kind of catch the next wave of capital. Now we're seeing it trickle down into the mid tiers and intermediate producers. Look at Equinox Gold, is probably the best performing, single gold mining company out there right now. So we're starting to see that money trickle down. Of course, it hasn't come down to the juniors yet, but that's it's an inevitability in my opinion. The question is, again, do we see a risk-off event first before the juniors move, or does the broader market stay stable or even continue to advance here in the coming months? In that case, I think a move in the juniors could be imminent.
Matt, we've really found ourselves in an extremely undervalued sector, that being the commodities, let's say, relative to the Dow.
Sure.
Is this a big part of your thesis that drives you into this sector when understanding how these types of cyclical trends rebalance over time?
Massive. Yeah, I'm a massive believer in mean reversion, particularly within a sector like mining and natural resources more generally, which is basically, aside from shipping, the most cyclical sector out there. And there's a reason for that. The first is that it's one of the more capital intensive sectors in the world. And the second is that there's very long lead times between when you press go on a project and when you actually see first production. I mean, the best example is these mega copper projects, for instance. Copper could go up to $10 tomorrow, and it's going to be 4 or 5 years before we see a major supply response. Even if the major copper producers throw all their chips in the middle and say, let's get these development stage projects to first production as quickly as humanly possible, to take a $4 or $5 billion project from feasibility stage to nameplate production is truly a 4 to 5 year undertaking. And another trend, just while we're on this topic, is that it also likely takes more than one major mining group, because these companies are constrained in terms of resources. There's not many folks remaining in the industry that have built major mines. A lack of talent amongst mining engineers and geologists is quite acute. And speaking as a younger person myself, we've yet to see waves of young people coming back into the mining space. I think mining will become sexy again. In fact, I'm quite confident about that. But it's going to be a long time between mining becoming sexy and recently graduated college grads actually being able to contribute in a real way to increase supply. So yes, reversion to the mean is a reality in this space. And, we go from overshooting to undershooting and then back again. So we're somewhere towards the bottom of the cycle. And based on the lag times and the lack of extreme capital expenditures, I have a good feel that for the next 5, 6 years, 7 years, at least, this is going to be a good place to be. But of course, there's going to be volatility along the way. And in any given time, if the broader market goes risk off, we may feel pain. So I don't want folks listening to think that it's going to be peaches and cream throughout this whole decade. But I think for those with the conviction to weather volatility and also the patience to make investments and hold them over multiple year time horizons, we're going to do just fine.
Matt, is this trend also really supported by a positive change in attitude towards mining from, let's say, the Biden and the Trudeau administrations as well?
Yeah, I find that to be one of the more fascinating dynamics we've seen over the past couple of years. Just the really unprecedented amount of federal financial support and provincial financial support that we're seeing to incentivize new metals and mining supply, particularly amongst the so-called critical minerals. And it's ironic to me that this is occurring, as you said, under two left-leaning administrations, where the constituencies of both Trudeau and Biden are decidedly anti-mining as it stands. But both of these administrations understand the significance, both for climate goals, which can be debatable, but also for national security and for just straight up economic interests. So they've gotten it. At least they've gotten half of the story right. Financial support is part of it, but permitting is the other half. And you can throw a ton of money at a given development project, but if the permitting process stays slow, you're not going to get the supply response as quickly as you would have hoped. I think we're starting to see these, at least in the US, the administration acknowledging that throwing money at the problem is not enough. There has to be a streamlining of permitting reforms. You might have seen last week, South 32's Taylor Hermosa project just got checkmarked by the federal government to be fast-tracked here. And so we actually are starting to see some belated moves on the permitting front to at least identify projects that the federal government wants to push forward in an expedited fashion. Taylor Hermosa, of course, has a large amount of zinc, lead, and manganese, which I think is the reason that they were selected, because manganese, of course, is a critical component in battery cathode chemistries, namely nickel, manganese, cobalt cathodes. Mm-hmm. So yeah, it's I still think that there's a major learning curve for the general public. Mining is still viewed as a dirty, stodgy, old-fashioned industry. But it's up for folks like us to share with the general public. If you believe in alternative energy sources, if you believe in electric vehicles, if you believe in revamping our electricity grid to modern standards so we can compete with the rest of the world, then you inherently have to be for responsible mining. And if not, you're either ignorant or you're a hypocrite. And I think a lot of it is ignorance. And my hope is that over the coming years, the learning curve here will steepen amongst the general public. I also think these investments will do well over the medium to long term, and I think that's also going to attract generalists back into the space, not for moral reasons, not because they love mining, but because there's money to be made. So I think this critical minerals push is real, actually, and it has the opportunity to transform the space and make it popular again. That said, that does not mean that these critical mineral investments are necessarily going to do well in the next 6 or 12 months. I feel better over the medium or longer term, but if we go into a true risk-off environment, there's probably there's probably no metal and associated equities that will suffer more than, say, lithium, where we've seen a huge amount of speculative hype in the space as recently as just a few months ago. And when that tide comes out, there will be pain ahead. And it's quite possible for lithium equities and the price of lithium to be much higher 5 or 7 years down the line, but down another 50% 6 months from now. There's nothing stopping from both of those scenarios from being true.
So Matt, on that subject of lithium miners, what dynamics are at play within that market right now? You just alluded to the sharp correction over the last few months, but what dynamics have caused that, and as you said, are maybe not stopping it continuing over the next couple?
Yeah, well, comes back to one of the more cliche adages in the mining space: the best cure for high prices is high prices. And we saw an extreme re-rating in the prices of certain the disparate lithium products, and as anticipated, it has resulted in a supply response. Bank of America put out some research a couple months ago. They're expecting 6 mines to either come online or be restarted in the next 6 months. That's intense. That's a major supply response. Think of copper. Can you think of 6 copper mines coming online in the next 6 months? No. Even gold, 6 gold mines coming online in the next 6 months. These are much better or much larger markets in terms of total size. But the niche lithium market is seeing that true supply response. Additionally, investors just plunged significant amounts of money into development stage names and exploration stage names amongst the lithium space. So I think the high prices have served their purpose, and we will see a supply, and we are seeing a supply response. So I'm quite cautious on lithium in particular, just due to the speculative fervor that we saw as recently as a few months ago. There was a period there where every day you saw a new lithium company listing, or you saw a company that you'd been following for 5 years and they'd been focusing on gold exploration, suddenly finding a pegmatite occurrence in the corner of their property and promoting that. In January, you saw 3 different prospect generators announce that they had lithium project portfolios. And again, that was all publicly available information. All one had to do was look. And these companies re-rated between 50 to 100% just on a single announcement. Like, that type of behavior is just not sustainable and is a sign to me of a near-term market peak. Mm-hmm. And if you look back to lithium's had multiple cycles here over the past 20 years. The most recent one was the 2014 to late 2017 cycle. And we participated in that one through a company called Lithium Americas, which is still alive and thriving today, and actually made a 10-bagger in that investment over that period. And between late 2017 and mid 2020, there was a 2.5-year pullback really across the lithium space. So I think it's unlikely for this current pullback to be short and quick. The history tells us that after a speculative bonanza like we saw late last year, early this year, it can take 2 years, 2.5 years for the excesses to be cleansed out of the system. So we do have a little bit of indirect lithium exposure through a couple of our holdings. But even despite the sharp pullback in both lithium price and many of the equities, I'm not chomping at the bit to jump back in anytime soon.
Matt, when we think about let's say this political move to secure some of these critical minerals within our own borders for the US and Canada, would it not make sense to be really going after some refining capacity alongside the mining capacity of those critical minerals? Yeah,
well, that's more than half the battle. That's why it's tough to create these vertically integrated supply chains basically overnight. I mean, yeah, mining is just half of it. And we could mine a lot more lithium and a lot more graphite. And if we don't invest in the refining capacity, that material will just be shipped straight to China as it is currently. So you do see some mining companies trying to embrace a vertically integrated strategy. You have others that are focusing just on the mining aspect of things. But we are seeing some movement. There's multiple gigafactories that have been announced and we're just starting to see ground broken across the United States. Some of these are focused on nickel, nickel cathode precursor materials. I'm following quite closely the trend towards LFP, lithium ion phosphate batteries, which I think by 2030 is likely to be the dominant battery chemistry, at least amongst electric vehicles. There is some debate there. I think McKinsey would agree with me. There are other groups following the space closely that would disagree. But that's one of the technology trends that I'm following most closely right now. But yes, to your broader point, that's and we're seeing some of this federal funding going towards these midstream projects as well. So I think the federal governments recognize that. That said, from an MJG perspective, we invest fully upstream. So I'm focusing my efforts on the actual mineral projects. And yes, some of these companies are also stepping down midstream, which I'm okay with. But we're not investing specifically in the midstream opportunities. What kinds of critical minerals do you think we should be including in our analysis here to make sure that we have supplies in the scenario where they could be held hostage from other nations not wanting to export them? In terms of those that aren't already included in the list, I mean, these lists are pretty comprehensive. I'm pretty sure the Canadian list has at least 30 different minerals on it. In the United States, surprisingly, copper is not included as a critical mineral, which I just think is foolish. Copper is truly the veins and arteries of our electrified world. Taking electricity from point A to point B, and we can build all these interesting applications and mine all these other minor metals. But if we don't have copper, it's all for naught. And the supply picture in copper is perhaps the most concerning. Lithium, for instance, which we touched on, the issue is not lack of lithium out there. The issue is a lack of lithium projects that are in production as it stands. Copper's a different story, though. I mean, copper's been mined for centuries. And a lot of the low-hanging fruit, most all of the low-hanging fruit has either been exhausted or is in production currently. Mm-hmm. And, as discussed, there needs to be a vast amount of new copper supply coming online. A good data point that I've recently come across here is that over the next, say, 12 years, there needs to be an Escondida equivalent coming online every year and a half. And again, you press the button and start construction on a copper project today, it's going to be a 4 or 5 year lag. So we're already going to miss out on that as is. And the numbers are pretty staggering. So I think folks are going to be paying a lot more attention to copper in the middle and later stages of this decade. And it may steal some of the thunder from some of the other critical minerals, like lithium, for instance, that are currently flavor of the month. One of the other beauties or dangers, I guess, depending on how you're looking at it, out of copper is a very limited substitutability. In some applications, you can use aluminum in lieu of copper if you're willing to accept, 40 or 60% of the efficiency. But in many applications, there's just no other metal that can be used to replace it. And that's different from a lot of these other critical minerals, where if the prices go too crazy, there are other technologies that can be brought in to supplement, lithium included. I mean, there's a lot of hype right now about sodium ion batteries that aren't using lithium whatsoever. I'm not expecting those to be embraced commercially this decade. But if we find lithium prices recurrently high over the course of this decade, that's just going to be more and more of an impetus to switch to a different predominant battery technology. There's just not the same luxury with copper. So, copper as it stands is our largest metal by weighting within the MJG portfolio. I try not to get sucked into these metal price narratives. Obviously, I'm following things, but focus on the quality people working on quality projects at reasonable valuations. That said, I'm very comfortable with our copper exposure, and I don't feel overweight as it stands. At roughly 20% of the overall portfolio.
So, even though we are many commentators in the space say that we're basically facing a global slowdown here or recession, you feel comfortable offsetting copper demand or possible waning copper demand by having the proper projects and people in place.
Yeah, it's tricky. I mean, these next 6 or 12 months, I oscillate between being bullish on copper in the medium term or in the immediate term and being quite fearful. Look, they're smart. Historically, when you go into a major economic slowdown, copper gets smacked. And we have seen that in the copper chart just over the past few weeks. That said, there are incredibly sophisticated groups that know this market inside and out. The Glencores, the Trafiguras, Richard Adkerson from Freeport-McMoRan, who are saying copper prices are going to go to all-time highs in the matter of 6 or 9 months. And that's just due to there being dwindling inventories and us simply running out of warehouse metal within this next year. So and then of course the other angle is we have the world's second largest economy, largest consumer of copper at 55% global copper supply, turning online after 2.5, 3 years of lockdowns. Now, the actual pace of the restart and the reopening has disappointed, of course, and we've seen that weakness in recent weeks. But I still wouldn't overlook the importance of that on copper in the copper market in particular. So it's tough. Fortunately for the MJG investment time horizon, and I would encourage listeners to do the same. I'm not too worried about what's going to happen over the next 6 or 12 months. Of course, that's easier said than done, but I'm thinking about the middle of this decade and the latter part of this decade, and the opportunity specifically amongst copper is and the names that we hold that are focused on that metal is so compelling that I'm willing to weather what volatility that comes. And I think there's a bigger risk, trying to get too cute and time things perfectly, because that's very difficult to do. That's very difficult to do in this industry. I don't have the ability to do that. Some folks do. But when I'm confident about something transpiring in the medium to long term, I have the ability to weather volatility in the short term, and you just need to have that conviction ultimately.
Going back to those lists that we mentioned of the critical minerals, do those exclude gold and silver as metals of focus for both countries?
Yes, to my understanding. Silver, I would quibble about it. I mean, silver is quite important. Over 65% of silver is going towards industrial demand. Silver is also an important component in photovoltaic solar panels. And actually, the trend that we're seeing is for the silver content per panel to increase. Now, I think that's going to change as the silver price moves higher. Look, folks that silver bulls or silver bugs, you could say, are a special type of crazy. That said, I think there is reason to be excited about the metal. I mean, we literally have gold prices trading right at its all-time highs, where as it stands, the silver price would have to more than double from current levels before it were to be knocking on the door of all-time highs. And I think that can actually be a good contrarian indicator of when this precious metal move is maybe drawing towards the end. There's nothing stopping silver from exceeding its all-time highs, but at the very least, when you see silver closer to 50 than it is today, you can have a sense, maybe a good amount or most of the move has occurred. We're nowhere close to that as it stands. So silver's kind of its own case. Gold, look, I mean, 90% of it's either going to jewelry, either going into coins, or going into bars. And 9-10% of it is used industrially. So I think it's fair not to include gold on the list of these critical minerals. The reality is gold's actually an incredibly useful metal. And if it's trading at 1/50th of the price, its industrial demand would probably be more than half of gold demand. But it's so pricey that unless it's absolutely irreplaceable in specific applications, whoever's doing the manufacturing is going to choose other metals, even if there's subpar performance, just from a cost perspective. And yes, I anticipate that to be the case for the foreseeable future. The other interesting thing about gold, I would just say more generally, this is something that's occurred to me in recent years, and it's something I believe for probably the past half decade, is that the industry as a whole has probably over-allocated resources and attention towards gold. So it's a fascinating metal. I have nothing against it. But in a given year, if you look at all the metal that's pulled up out of the ground, maybe 15% of the total value is for gold. And yet, if you look back in 2016, 45-50% of the junior companies out there were focused on the metal. So there seemed to be quite a mismatch. I think we're seeing that resolve somewhat with this critical minerals excitement, and that's probably going to continue. But I do feel as an industry at large, there has been a disproportionate amount of interest and resources attached to gold. And it's probably a misallocation of resources. I mean, I've always been attracted to the metals that allow us to live our 21st century lifestyle. And I would say, while gold does have some applications that is useful, it does not fall into the category of metals that are helping humans advance into the 21st century.
Mm-hmm. As part of that, let's say that positive turn by the administrations towards mining, we saw Canada order divestment of Chinese firms in lithium junior projects. So do you view this as a positive development, or think it should be considered a liability in companies that have some of this international ownership?
Good question. I would say it's a mixed blessing. It really needs to be looked at on a case-by-case basis. Definitely a headwind to existing companies that have large Chinese shareholders. And I think we've had the Canadian government back off a little bit since that pronouncement was made, I believe, in November of last year. That was definitely a shot across the bow, and it affected more than just the three companies where the forced divestiture occurred. That was assigned to both junior Canadian and American juniors and the Chinese, that maybe certain investments shouldn't be made due to these political pressures. Of course, for companies that don't have a large Chinese group on the cap table, you could maybe be looking at that as a positive. But I'm a believer in free markets, and this is a bit of an anti-competitive tilt that these governments are taking, in the name of national security and also national pride. I mean, the biggest example occurring recently is the Teck Glencore saga. And, Glencore is far from a Chinese company, but even there, we're seeing stiff opposition, both from the Canadian government and many metals and mining titans within Canada, who ironically have benefited from free markets and the ability for to invest in foreign countries and also to sell their projects to foreign entities on occasion. So it's a bit of a muddled situation as it stands. And it's something that I'm watching closely. Again, I don't think we'll see any immediate further forced divestitures, forced by either the Canadian or U.S. government. But the damage from what occurred in November may have already occurred, and it's definitely going to have a dampening effect on Canadian groups, either making strategic investments into Canadian entities or even considering acquiring projects in North America. And if you own one of those projects, then that's one less potential buyer on the table. I think it's less of an issue. You could be a Canadian-based company or U.S.-based company. I think it's less of an issue if your project is based overseas. There still might be some pushback. Of course, of the lithium names, I think 2 of the 3 actually had their projects based not in Canada. At least one of those was down in Argentina. But I think the risk is still slightly decreased if the location of your project's actually not in North America. But we'll see. It's still a dynamic situation.
Where else do you look at jurisdictionally for attractive investments around the world? I know that Brazil has grown recently in your portfolio. So run us through a couple of examples like that, if you wouldn't mind.
Sure. Well, in terms of your average mining investor, I'd say I'm more tolerant of geopolitical risk than most. I'm willing to invest in some pretty unsavory jurisdictions, or at least unpopular jurisdictions, if I think that the project and the people working on that project are special enough. The key is just to hedge your bets. So if you have an investment in Bosnia like we do, or we have an investment in Egypt like we do, then maybe don't invest in a second or third company focused on those jurisdictions. But I think if you can hedge your risk, by making sure that you don't have all your eggs in one basket. In terms of mineral belts of interest, don't take it from me. Let's take it from Mark Bristow. Probably the best CEO in the mining space today. He's on the record saying that Barrick is excited about 2 mineral belts. The first is the Central Tethyan Belt, which stretches from Turkey through Kazakhstan, all the way to Pakistan, where their Reko Diq project is being advanced, and they've made a construction decision there in Pakistan. And then Barrick is also very active in the Arabian-Nubian Shield. And that's the mineral belt that extends through Ethiopia, Eritrea, Egypt, and then crosses the Red Sea into the Arabian Peninsula, Saudi Arabia, etc. Barrick is active on both sides of the Red Sea, both in Saudi Arabia and in Egypt, where the Egyptian government just back in 2020, after having a pretty inhospitable mineral code for the past 30 years, made some major tweaks to make the jurisdiction more palatable for Western parties. And as a result, we've seen many Western parties come in, and Barrick being the largest. B2Gold is in there. Sentiment has been one of the few Western groups that are in country, and they're doubling and tripling down in country. So there's a lot of excitement in Egypt. I was actually there in early February and was able to visit the land package of Elemental Altus, which is a holding of ours. That's a royalty generator. This ground is 100% owned by them. At least one of the prospects is now drill ready. I'm not expecting them to fund the drilling given their business model. So I think in the relatively near term, we could see their Egypt portfolio either spun out into a standalone entity, sold perhaps with Elemental Altus retaining a royalty, or JV'd, or an earn-in deal being announced with the larger party coming in. So keeping a close eye on that. And then on the trip, we were also able to see Centamin's Sukari mine, which is the only commercial stage gold mine in Egypt. And it's an absolute beast of an operation. Last year churned out 440,000 ounces of gold, should be over 500,000 ounces of gold, by the end of 2025. That's what they're shooting for. And, as folks in this industry know, anything over 100,000 ounces of gold per annum is a pretty sizable operation. So that gives you a sense of the scale. So yes, long story short, I'm quite interested in those two mineral jurisdictions. Of course, with opportunity comes risk. There's a reason that these are some of the most highly prospective mineral belts in the world. They're dicey places to operate, and they can be unsafe in some cases. Look at what's happened in Ethiopia with this civil war that's now dragged on for 2 years, if not longer, which is a real shame. My understanding is that Newmont in the Tigray region had keyed into what has the potential to be a true tier 1 discovery. And I won't share any numbers on this during this talk, just because they're, I've heard them through the grapevine. But my understanding is they were churning out some incredible intersections and had to, straight up leave the country due to this conflict. So that's an example of some of the risks that one incurs by operating in this part of the world. But the potential is absolutely there. Going to Brazil. That is our largest, Canada is the jurisdiction where we have the most exposure to within the portfolio. Brazil is number 2 as it stands. So feeling overweight to Brazil. I'm comfortable with it due to the teams that we've invested in and the projects and the specific locations of the projects that we've invested in. Both of our large Brazil holdings I've written about in previous MJG investor letters. So I'm happy to, or I'm comfortable mentioning the names here. One is Bravo Mining, one is Lara Exploration. Both of those are based in the Carajás region, which is the heart of mining country in Brazil. That's where Vale was born. So, you don't want to paint any jurisdiction with the broad brush. There are places within any jurisdiction, from the very best mining jurisdiction to the worst, where you'll either be able to build a mine or you simply won't. And so, Brazil is a large country, and there's many different projects located throughout it. If there is a place to be, I think it's within the Carajás, but everything should be looked at a case-by-case basis, both the location of the specific project and also the track record of management being able to advance a given project through to production. And for Bravo, for instance, that box is completely checked. Luis Acevedo, the CEO there, is a Brazilian national, one of Brazil's preeminent mining lawyers who have worked with the largest companies in Brazil to advance permitting. And his last big deal, Avanco, he took from a development stage project through to production, receiving all required permits before it was sold to Oz Minerals back in 2018, if I'm not mistaken. So, the given project matters, and the people that are pushing it forward are just as important.
Matt, usually when M&A picks up, that's a sign of things really starting to heat up within the mining space. When do you think that next big wave of M&A to occur?
We're in it. We're in it. I've been chuckling in recent weeks whenever I hear, market prognosticators talking about, the M&A is coming. It's here right now. And in my opinion, there's no debate. I wrote down a few of these names, but just look at the size of these acquisitions. There's Glencore and Teck. There's Newcrest and Newmont, which we just found out yesterday is going forward officially. But there's a whole host of other deals from recent months that can be easy to forget. BHP took over Oz Minerals. That was a sizable acquisition. Mincor is in the process of being gobbled up by Andrew Forrest's Wyloo Metals. Hudbay and Copper Mountain are merging together, and they're going to become kind of one of the larger, intermediate copper players out there. Lundin Mining acquiring the Caserones asset in the Vicuña district in Chile for just under $1 billion. That was of particular interest to me and the MJG fund, given that we own 2 royalty generators that have royalties over that specific asset. So that was actually really exciting to see Caserones going to a publicly traded group. The previous owner. Well, actually, JX Nippon is still involved, but they'll now be the minority owner. And now we have Lundin Mining as the operator. So they're going to be producing technical reports, which makes it much easier to value the royalty. There will be increased visibility of the asset just due to the stature of Lundin Mining. And these guys are explorationists through and through. So they're making quite a few noises that there's a lot of exploration that's going to occur on the royalty land package. Of course, for a royalty holder, all that comes for free. And the exploration upside could be a really big deal for the value of those royalties. And heck, just in the past week, Fortuna Mining taking over Chesser Resources in West Africa. Late last week, SSR Mining announcing that it was acquiring a 40% stake in Hodmodden in Turkey and becoming the operator there. Goldfields announcing a 50% JV at a Cisco Mining's Windfall project. And just this morning, Silvercorp, taking over ASX listed Celsius Resources. So I think we're right in the heart of a true M&A binge. I'm not sure how long it goes on, but I think it's foolish to expect anything more. Like, this is a massive amount of deals, really from the top of the mining industry down to some of the smaller names. Integra and Millennial Precious Metal tie-up is another one that comes to mind. I was just at the Canaccord conference last week in Palm Desert, and there was a rumor flying around that there's going to be further consolidation within the junior royalty space, and that one of the more aggressive players is currently either planning or implementing their next hostile bid. So there's just a lot going on, and I think that's important to recognize. We're in the midst of the next M&A wave. I don't think it can get much more rapid fire than this.
Mm-hmm. Yeah, some great examples there, Matt. And you're very squarely focused on the junior mining space.
That's right.
Kind of in general, what are some of the biggest mistakes one can make investing in that space?
Sure. Well, the list is long. Mm-hmm. And I'll throw out a couple. I'll throw out a couple of them in no particular order. But this could be an hour-long conversation in its own right. And of course, I've made many mistakes myself as an investor, and we all do. And the key is to learn from them and try not to repeat them. So a lot of this is going through learning through experience and refining your process as you go. So that's certainly been the approach I've taken. Probably the biggest, and this is more of a novice or rookie mistake for those that come into the space, is getting really wrapped up in a specific supply-demand narrative for a given metal, and then buying juniors, especially explorers, particularly explorers, and thinking that they're going to benefit because a given commodity moves. If you want to own gold, if you want exposure to gold because you think the price of gold's going to go up, you should buy physical gold, or you should buy Franco, or you should buy one of the larger producers, and then you can sit quietly. You don't have to track it on a day-to-day basis. But if invested in a gold junior, you need to be following that name from news release to news release, understanding that any given news release could be a reason to liquidate the position immediately. And also understanding that the metal price in question, it could be a copper-focused explorer. Copper could go up 3x, and you could lose a significant sum of your investment because a copper explorer is exploring for copper. They don't have exposure to it. Maybe a development stage asset where there are pounds in the ground. You do have a bit more of a linkage between the equity price and the metal. But even a great copper development project that looks great on paper and the copper price goes up 3x, if it's not going to get permitted or it's not going to get the social license to be built, then that's ultimately going to be a zero as well. So I think it's really important not to get caught up in a given metal price narrative. And if you're investing in the juniors, do it truly on a bottom-up basis. So when I'm evaluating an investment, it always starts with the people. You then look at the asset, assuming flat or even lower metal prices. I think that's when you factor in the E and the S of ESG. Then you want to look at the company's financial structure, their catalysts, to get a sense of, will they be able to achieve at least one and hopefully a couple catalysts without raising additional money? they need to raise additional money, that's fine. This is a capital intensive industry, but then why buy the stock? Why not sit on your hands, and you can always participate in that placement when it comes. Then looking at the company's price to value metrics, only then do I consider the metal of interest. And that more is just, how does that fit within the current MJG portfolio? Like, are we too exposed to a given metal, or do I feel comfortable taking some metal price risk? But I really do think it's important to de-emphasize the metal being focused on. I guess a second mistake, and this is actually more common for geologists, but I think it's easy to fall in love with the rocks. And again, it's cliche, but it's so much more important from my perspective to bet on the people versus a specific project. Betting on the jockey over the horse, and in other parlance. An excellent management team can make mediocre projects work, or they can use their connections and reputation and gravitas within the space to acquire a new asset that can completely change a company's trajectory. Mm-hmm. And there's plenty of cases of, quality or very high quality projects that are butchered by a management team that's either incompetent or crooked. And there are plenty of groups out there that you don't want to invest in, that are more interested in lining their own pockets than they are making their shareholders money. So focus on the people, not the rocks, not the project. You'll find that good people attract good assets inherently. And so focusing on the people will almost ensure that you're investing in good projects as well. Let's see, know where you are in the cycle. I think that's an important point. This is an incredibly cyclical industry, as we discussed, both due to the capital intensity and long lead times of construction and development. You're never going to be able to know with any specific amount of precision exactly where we are, but you can have a general sense, looking at relative valuations like we talked about, or looking at CapEx spend charts, spanning back decades, where we are. We're nowhere near the amount of money being deployed in 2011, 2010, 2011 timeframe. Later this decade, we're going to surpass that. And once that occurs, you're going to get a sense that, okay, well, we're closer to the end of the cycle than we were in 2023. So again, back of the envelope. But the reality is, a lot of people, especially novices and generalists who haven't invested in the space, they get introduced to the space at the very tops of the cycles. And of course, that makes sense. That's when people are making money. That's when people are excited. That's where the hype, truly occurs. And so because we're not at the top of a cycle, I doubt there are too many, pure generalists or knowledges that are even going to listen to this, to the specific podcast. But it's important to know where you are in the cycle, and, time your entry and exit points, well. And, I guess mentioned previously in this answer, especially if you're an investor that can't participate in private placements, it may be best to just focus on opportunities that are either cash flowing or have enough cash in the bank where they can go years without raising additional capital. Because if you're buying on the open market with a company that has a history of raising every 6 months or every 12 months, you're playing with a loaded deck, and it's not loaded in your favor. There are other investors and insiders that are participating in these placements, and they're getting discounts. They're getting warrant sweeteners. And you're a sitting duck in a lot of cases if you're buying on the open market, especially in circumstances where the company clearly needs to raise money before they can achieve their next potential share price catalyst. So I would say for investors that don't participate in private placements, consider looking at names that don't often raise or don't need to raise at all. And that will often be the royalty names or project generators. That's what I like about those two business models. They're probably the closest thing to a buy and hold that you can have in this space. And that's probably more suitable for many investors that, again, don't have the connections or even the ability to participate in financings.
Mm-hmm. Yeah, some interesting things to consider there, Matt, that I don't know that we've really gone over in such detail like that for people to consider on, let's say, what their individual risk tolerance is and or should be.
Yeah, I hope that's helpful. And another quick one that comes to mind is focus on the people and how many obligations are they have they currently undertaken? Like, is the specific management team all in on a given opportunity? Like, it's very difficult to make a success out of a junior company. And if you're focused on 6 vehicles at any given time, drawing salaries from each of them, you're diluting your time, you're diluting your chances of any of those specific ones succeeding. Even a management team razor focused on a single opportunity, there's no guarantee of success. But at least you're maximizing your chances of there being a success. And you know that management team is putting on a day-to-day basis, putting themselves on the line, trying to make it work. So, stuff that's as simple as that can go a long way as an investor. Looking at where management got their shares from. Obviously, the more skin in the game, the better. And if you confine your investments to management teams that own more than, say, 10% of the company, I think you're in good shape doing that. But also, how do they get those shares? Do they get a bunch of cheap options, or did they have a shell that a new company went into and they've put up no money on their own? Or has the given management team plowed hundreds of thousands or millions of dollars of their own money into the specific story? And like the difference between those two can be the difference between success and failure for specific investments. So focus on the people and how they're incentivized. I think that's close to half the battle right there.
Mm-hmm. I was going to say something that comes back time and time again on this show is looking at the incentives and seeing how those align with you and your investing goals.
That's right.
Well, Matt, I think that's a good place to kind of wrap up today's discussion. That was a great chat on everything more encompassing of the rest of the mining cycle here and the broader commodity cycle. Where would you point people to if they want to learn more about you and the fund?
Oh, sure. The fund's website is mjgcapital.com, and you'll find all investor letters published on the website, as well as press appearances and podcasts such as this. For those that want to be put on the list, there's a contact form. Just feel free to reach out, and I can add you to the MJG investor list. As you mentioned, I go for quality over quantity, so I'll only put out 2 investor letters per year. The next one's due to come out sometime in mid-July. And I try to do a very comprehensive letter, generally 40 to 50 pages with an update on how the fund is positioned, some market commentary, a featured investment to try to give a sense of perspective to prospective investors as well as current partners, how we're invested and why we're investing. And then also updates on previous featured investments that we still own in the portfolio. So it's quite an undertaking. It's always painful, but when I press send, I definitely feel good about it and always receive good feedback. So for anybody interested in receiving that or reading past investor letters, it's all there for you on the website mjgcapital.com.
Excellent, Matt. Thanks so much for sharing your thoughts and ideas with us today.
Thanks, Tom. Always good to join you. Thanks.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.